Welcome to TalkTickers. You're busy, but you still need to know what's driving the markets.
And that's exactly where we come in.
Today, we're diving into the recent earnings call for Eaton.
Right.
The big question, I think, is, does this strong first quarter signal, sustained momentum?
Yeah.
Especially with everything going on globally.
Yeah, that's the key question. And Eaton definitely started 2025 strong. No doubt about it.
Okay, so give us the snapshot.
Well, they reported a record-adjusted EPS, $2.72.
$2.72.
Which is a pretty solid 13% jump year over year.
Nice.
And what's really interesting, I think, is the acceleration in their organic growth. It jumped to 9%.
Up from
6% of the previous quarter, so a noticeable pickup.
And where was that strength coming from mainly?
Particularly strong showings in Electrical Americas, Aerospace, and Electrical Global. Pretty broad-based.
Okay, so growth is accelerating. What about profitability? Margins holding up?
They were record segment margins, actually, 23.9%.
And that was expected.
Yeah, right in line with their guidance. So they delivered there.
Good.
They also saw total company orders increase about 3% versus the prior quarter.
Which
resulted in a book-to-bill ratio of 1.1.
Always good to see that above 1. More orders coming in than going out.
Exactly. It's a good sign for future revenue. And their backlog grew too, both year over year and sequentially.
So looking ahead.
They've actually raised their expectations for organic growth for the full year.
Oh, interesting.
Yeah. But they did reaffirm their guidance on adjusted EPS, cash flow, and share repurchases.
Okay. So raised growth outlook, but keeping earnings and cash flow steady. Got it. A pretty positive start then.
Overall, yeah. A very strong Q1 picture.
Okay, so that's the headline numbers. Strong start. But beyond that, there is some pretty significant news on the leadership front, right?
That's right. A big transition coming up. Craig Arnold is set to retire at the end of this month.
After how long?
After 25 years with Eaton, a really long tenure. And that includes 9 years as chairman and CEO.
Wow. Quite the legacy.
Definitely. And the company made a point to highlight his contributions, shaping the culture, ethics, transforming the portfolio.
And the shareholder returns, I imagine.
Oh, yeah. Significant returns. They put some numbers on it. The stock went from around $61.65 back in June 2016 to $294.37 as of the end of April this year.
That's a huge jump. Quite a run under his leadership.
No kidding. A substantial increase.
Okay. So leadership transition underway. And alongside that, they also closed an acquisition, didn't they? Something strategic.
Yes, exactly. They successfully closed the FiberBond acquisition on April 1st.
FiberBond. And the focus there is?
It's really aimed squarely at the data center market, capitalizing on the need for better capital efficiency and faster deployment.
Makes sense. Everyone wants things faster and cheaper, especially in data centers.
Right. The idea is FiberBond helps operators expand their IT footprint, squeeze more revenue per square foot out of their facilities.
So clearly doubling down on that whole data center boom.
It certainly signals that, yes.
And they put this into a wider context, I think, talking about broader trends.
They did. They gave an overview of the 8 key end markets they serve and the sort of mega trends driving long-term growth there.
And they feel good about those prospects.
Yeah, express strong confidence in the long-term growth picture across those markets.
Okay, let's maybe dig into the segments now. See how each part of the business performed in Q1. Starting with the biggest, Electrical Americas. Sounds like a standout.
It really was. A record quarter for them. Organic sales growth accelerated pretty impressively, up to 13%.
13%? Wow. What fueled that?
Primarily driven by, as you might expect, the data center market and also utilities. Both very strong.
And margins.
Also very strong. Operating margin hit 30%.
30%.
Yeah, up 80 basis points compared to last year. So almost a full percentage point improvement. Shows good efficiency.
But orders were down slightly year over year. I saw that.
They were down 4%. But there's important context there. It was up against a really tough comparison. Yeah, they had a huge multi-year data center order in Q1 of 24. So you take that unusual large order out.
Then what happened?
Orders were actually up 4%. Specifically, data center orders jumped 11%.
Got it. So the underlying trend is still very much positive.
Very positive, yeah. And the backlog there is huge, $10.1 billion.
$10 billion.
And what's also really noteworthy is their pipeline for major project negotiations.
How's that looking?
It's way up, 18% versus just the prior quarter. And get this, 168% since Q1 of 2023.
Whoa, 168%. That's massive. Suggests a lot of future potential.
Absolutely. So reflecting all that, they raised their full-year organic growth guidance for Electrical Americas by 150 basis points.
You know the new ranges?
Now 12 to 14%.
Okay. But the margin guidance for that segment came down slightly by 80 basis points.
It did, yeah. That probably reflects some, increased costs tied to meeting that higher demand, maybe some investments for future growth. Mix could play a role too.
Makes sense. Okay,
Yeah.
What about Electrical Global, the other big electrical piece?
Also saw accelerated organic growth, hit 9%, up from 5.5% last quarter.
Pick up its here.
Yeah. Though they did have about a 2% drag from foreign exchange rates.
Right.
So constant currency growth was even stronger.
Right. Where was the strength geographically or by market?
Data center again. Machinery, utilities were strong end markets. Geographically, double-digit organic growth in Asia Pacific. And they saw recovery in the Middle East and Africa, MEA.
And margins there.
Improved. Operating margin was 18.6%, up 30 basis points year over year.
Okay, how about orders?
Overall, orders were flat compared to last year. But sequentially, they saw increases in MEA, their GIS business-grade infrastructure solutions, and APAC. APAC was up over 30% sequentially.
Sequentially. Okay, and backlog.
Backlog grew too, up 5% year over year and 6% from the previous quarter.
So if you combine both electrical segments, what's the picture?
Combined, it's pretty impressive. 11% organic growth and a combined segment margin of 26.1%.
Up how much?
Up 88 basis points overall for electrical. So strong performance across the board there. Good stuff. Okay, moving on. Aerospace. That seemed like another bright spot.
Absolutely. Firing on all cylinders there. Record sales, 13% organic growth.
Across the board.
Pretty much all end markets. Particular strength in military aftermarket, commercial aftermarket, and also military OEM.
And profitability.
Really robust operating margin, 23.1%.
Solid. Orders.
Orders were up 14% year over year.
A book-to-bill.
Healthy 1.1 again, which led to a big jump in backlog, up 16% year over year and 5% sequentially.
16% backlog growth.
Yeah. So reflecting that strength, they actually raised their defense aerospace growth outlook specifically, moved it up to solid.
Okay. Now, it wasn't all sunshine and roses, was it? The vehicle segment looked like it hit some bumps.
Yeah, that's fair. Vehicle definitely faced some headwinds. Revenue was down 15%.
And
Organically, it was an 11% decline.
Why was that?
Primarily due to weakness in commercial vehicles and also the traditional internal combustion engine ICE light vehicle market, particularly in North America. Right. But margins held up okay.
Reasonably well, considering the top line pressure. They managed a 15.5% operating margin.
Still respectable, but guidance took a hit.
It did, yeah. Full year growth guidance for vehicle was cut pretty significantly by 350 basis points.
So the new expectation is?
Now expecting a decline between 5.5% and 3.5%. And operating margin guidance was also layered by 200 basis points. So definitely adjust expectations there.
Okay. And related to that, e-mobility. That's always an interesting one. Lots of potential, but volatile.
Right. E-mobility saw a small revenue increase, but 2%. Organically, it was 3%.
Okay. Margins
were flat. Yeah. And they put that down to ongoing investments in their growth programs in that space, still building things out.
Are they seeing opportunities?
They said the opportunity pipeline is expanding, which is positive, but the overall growth outlook for e-mobility got trimmed a bit.
How so?
They lowered it to solid. It was previously strong double digit, so a moderation there.
And that ties into the broader vehicle market view.
Yeah, exactly. They also tweaked their forecast for ICE light vehicles overall, now expecting a slight decline for the year instead of the slight growth they previously saw.
Got it. Okay, shifting gears a bit. Tariffs and the whole global trade environment, that's a huge topic. How is Eaton navigating that?
Yeah, they addressed that directly, talked about the uncertainties. Their main strategy, they emphasized, is this long-standing focus on localized sourcing and manufacturing. Local for local.
Right. Making things where you sell them helps mitigate some of that risk.
Exactly. And they highlighted recent investments they've made specifically to boost their U.S. manufacturing footprint.
Building resilience.
Yeah, and they mentioned other steps too, post-COVID. Things like making supply chains more flexible, using digital tools, basically trying to be prepared.
But what about the actual financial impact of tariffs? Can they offset it?
They stated their plan is to offset the sort of dollar for dollar impact, using a playbook of, cost management, supply chain actions, and pricing.
Okay, but does that fully protect margins immediately?
Not this year, they said. They expect to recover from a margin standpoint over time, but they don't see that happening fully in 2025. There's a lag.
So a margin headwind this year from tariffs, even if they offset the dollars?
Yeah, it seems to be the expectation, yes. using those three levers. Cost, supply chain, and price.
Okay. Let's talk about mega projects. That seemed like a really big opportunity area they highlighted. The numbers were kind of eye-popping.
They really were. Q1 was huge for announcements. 42 projects announced, totaling, wait for it, $169 billion.
Billion? Wow. How does that compare?
That's up over 40% compared to Q1 last year. And the average monthly announcement rate is now around $57 billion.
Incredible pace. Are these projects actually starting?
Well, that's the interesting part. They said only about 15% of those announced projects have actually broken ground yet.
So it's a very long tail opportunity.
Exactly. A huge pipeline stretching out. And forecasts, like from Dodge, anticipate a massive jump in actual starts this year. Maybe $300 billion compared to $135 billion last year.
Are projects getting canceled much?
The cancellation rate remains pretty low, they said, around 11%.
So how much of this are they actually booking in orders right now?
To date, less than $2 billion booked directly from these specific mega projects.
Yeah.
But their current negotiation pipeline for these is $3.6 billion.
Okay, so significant potential orders coming down the pike.
Definitely looks that way.
And tied into that, data center growth specifically. We touched on it, but it sounds like it was even better than expected.
It was. Strong double-digit growth in Q1. They mentioned it exceeded the 45% rate they'd shared previously.
Exceeded 45%. That's huge.
Yeah, and they're very bullish going forward. Lots of negotiation activity, plus the excitement around the FiberBond acquisition.
So they expect orders to stay strong.
Yes, very much so. And they feel they have a competitive edge, especially in the U.S.
Because of?
Their significant existing footprint, plus these ongoing investments in expanding capacity. That whole local for local strategy plays well here, especially with potential trade issues.
Right, makes sense. Okay, let's wrap up the call highlights with the guidance updates. What were the key adjustments for the full year?
Okay, so for 2025, they nudged up the organic growth outlook by 50 basis points.
Your range.
7.5% to 9.5%.
But EPS guidance stayed the same?
Reaffirmed, yeah. Still $11.80 to $12.20 adjusted EPS. And they also reaffirmed cash flow and share repurchase expectations.
Okay. But segment margin guidance came down a bit.
Slightly, yes.
Yeah.
Lowered by 40 basis points for the full year, now expecting 24% to 24.4%.
And that's mainly due to the tariff situation.
Primarily, yes. Reflects the cost of offsetting those tariff impacts. Even if the dollars are covered, the margin percentage takes a small hit this year.
Right.
They also gave specific Q2 guidance.
Got it. And there was something about the timing of earnings between the first and second half. A slight shift.
Yeah, just a minor tweak. They now expect the first half to contribute about 47% of the full year's EPS. Down slightly from 48% previously.
Why the change?
Mainly a few corporate level things, like higher interest expense from financing the FiberBond deal, timing of some executive compensation.
Okay.
And also that slight delay they see in fully recovering the tariff impact in Q2. They estimated that as about a $20 million or 5 cent per share headwind just for Q2.
So a slightly more back half weighted year than initially thought, but not dramatically so.
Exactly. And historically, the first half is usually around 46% anyway, so it's not a huge deviation.
When you look at their overall growth, how much is coming from price increases versus actual volume?
Their take is that the overall end market growth is around 7%. Within that, there's a slight lift from pricing, partly due to tariffs, as we discussed, and a bit more contribution from actual volume increases.
And they think they can grow faster than that 7% market?
They express confidence they can, yeah. Mostly because of that strong backlog they already have booked.
And they're committed to managing costs and using price to offset tariffs.
Reiterate that commitment, yes. Yeah. Leveraging the cost base and taking necessary pricing actions.
Okay. Now, this point about data center backlog stretching out potentially 9 years. That's kind of wild. What does that mean for a company like Eaton?
Yeah, it's a fascinating dynamic. Eaton sees it as a signal that the industry is desperately looking for faster ways to build.
Which plays into
their modular solutions, like FiberBond, makes them potentially more relevant and in demand.
Right.
They're also seeing data center operators being more open to, broader solution discussions with companies like Eaton that have a wide portfolio.
So opportunity there. Are they investing to capture it?
Yes, continuing to invest, hiring experts. But interestingly, while the industry backlog is extending, they haven't seen a big shift towards 9-year long-term agreements directly with their customers yet. That seems more of an overall industry capacity thing.
What about barriers to entry in this space?
Key things they mentioned. You absolutely need to be on the approved vendor lists for the big operators. That takes time and effort. And increasingly, close collaboration with the chip manufacturers, like NVIDIA, is becoming really important. You need to understand where the technology is heading.
Speaking of NVIDIA and AI, how is that changing things? The move to higher power densities, Blackwell chips, etc.
They see that as a positive trend for them. Higher rack power densities generally mean more electrical content is needed.
More Eaton gear per megawatt.
Essentially, yes. They expect increased dollar content per megawatt in these new AI data centers, both because of the raw power needed and also because you still need things like UPS systems, even if you're using liquid cooling for the chips themselves.
Are they developing specific solutions for AI data centers?
They are. Working on modular solutions designed for both retrofits and brand new greenfield AI builds.
And they expect Electrical Americas book-to-bill to stay strong because of this?
Yes, expected to remain above 1, indicating continued strong demand feeding that segment.
Okay. Quick question on electrical global profitability that's been a focus area. Any updates?
Still, very much a focus, yes. Margin improvement is a priority there. And most of their current restructuring efforts are actually targeted at the global segment.
When will we see the impact of that restructuring?
They expect the second half of the year to be more impacted, both in terms of the cost of the programs and hopefully the savings starting to come through.
Gotcha. And finally, cash flow. What impacted cash conversion in Q1?
The main factor they called out was an intentional inventory build.
Why?
Primarily to manage the tariff situation proactively. Give them some buffer. They estimated it was about 4 days of inventory, maybe $150 million impact on cash in the quarter.
But full-year cash flow guidance is unchanged.
Unchanged, yes.
Yeah.
They expect to work that inventory down and recover over the year.
Any issues with collecting payments, DSO?
No, expect DSO to be relatively flat year over year. No specific issues flagged there.
And lead times, capacity, are they keeping up?
Lead times have improved, they said. Maybe 20-25% better depending on the product line, but still not quite back to normal pre-pandemic levels.
And capacity expansions.
Significant projects ongoing, couple dozen in North America alone to support the growth. More capacity coming online in the second half and into early next year.
Is that new investment or planned?
It's part of that $1.2 billion additional growth investment they announced previously before the latest tariff news. So they're executing on that plan.
Can they shift capacity between, say, data centers and utilities if needed?
Generally, yes. They said capacity is pretty fungible across different end markets. Investments are mainly in assembly, which gives them flexibility and significant output for the capital invested.
Okay, that covers the call details really well. Fantastic overview. Now, let's shift to our This Is Not Financial Advice segment. Time for some outrageous but plausible trade ideas based on all this. What have you got?
All right, idea 1. Given that huge surge we saw in the aerospace backlog, right? Especially military OEM and commercial aftermarket.
Yeah, and they raised the defense outlook.
Exactly. So one outrageous idea could be a straight long position on Eaton, betting that the market is maybe underappreciating just how strong and sustainable that aerospace performance could be.
Driven by?
Geopolitical tensions aren't exactly fading and air travel keeps recovering. Could be a longer, stronger tailwind for that division than people think.
Okay, interesting. Based on underappreciated aerospace strength. What's another angle? Maybe something thematic, competitive.
Okay, thematic play. We talked about Eaton's U.S. presence, that local strategy being an advantage with tariffs.
Right.
Now think about some of their European competitors. Many rely heavily on exporting electrical components into the U.S.
They'd be more exposed to tariffs on U.S. sales.
Precisely. So the outrageous idea here, consider shorting a key publicly traded European electrical competitor with significant U.S. exposure.
The thesis being?
The thesis being that the ongoing tariff environment could hit their margins and competitiveness in North America much harder than it hits Eaton. Eaton might even gain share.
A relative value play, essentially. Short the exposed competitor, maybe implicitly favoring Eaton.
Kinda, but, huge disclaimer here. This is definitely a wild idea. Needs massive research into specific competitors, their exact exposure, their own mitigation strategies.
Absolutely. Outrageous but plausible requires the plausible part to be heavily researched, not just outrageous.
Couldn't agree more. Just thought starters.
Definitely food for thought. Okay, that brings us nicely to the end of our deep dive into Eaton's latest earnings call.
We covered the key numbers, the strategic moves, the segment performance.
And of course, a couple of those unconventional market angles to mull over.
Hopefully this breakdown has given you, our listeners, a much clearer picture of what's driving Eaton right now and some of those bigger trends they're navigating.
Yeah, what really stood out to you? Any questions still buzzing around? We always like hearing listener perspectives.
Absolutely.
Thanks for tuning into TalkTickers today. We'll be back soon with another earnings deep dive.
And just the usual reminder, this was all for informational purposes.
Definitely not financial advice. Please, always do your own thorough due diligence before making any investment decisions.